Let's now look at Article 14.4, which deals with shares of a real estate company. And the clause that we are looking at is of India-Malaysia Treaty. What can happen is that in order to avoid taxation under Article 13.1, which was relating to transfer of immovable property, a person may actually incorporate a company which then owns an immovable property, right? The person or the non-resident, instead of transferring the immovable property, may actually sell the shares of the Indian company. In such a case, what is going to happen is that what is transferred are shares of the Indian company and not the immovable property. And therefore, technically, one can argue that Article 13.1 does not apply, which may actually result in loss of revenue to the source state or the state where the property is situated. To deal with such cases, normally there's a Article 14.4 in the treaty which deals with taxation of transfer of shares of a real estate company. And what I mean by real estate company, it is not a term which is used in the treaty itself, but this is a term which we have coined, which basically refers to a company whose predominant value is arrived at from immovable property. Let's look at Article 14.4. 14.4 of the India-Malaysia Treaty, generally it might be Article 13.4. Gains derived by a resident of a contracting state. So let's say this resident that we are talking about is a resident of Malaysia. So gains derived by a resident of Malaysia from alienation of shares deriving more than 50% of their value directly or indirectly from immovable property situated in the other contracting state. So if a resident of Malaysia owns a company, they transfer the shares of this company which owns immovable property in India, okay, and the value of the immovable property is more than 50% of the value of this company itself, right? Then, or any other right pertaining to such immovable property may be taxed in that other state. Which is the other state? India. So transfer of shares of an Indian company which derives more than 50% of their value, whether directly from immovable property or indirectly from immovable property, shall be taxable not only in Malaysia but also in India, right? Both the states have a right to tax such capital gain. We will now see some examples where we will deal with this 50% concept. Suppose there's a foreign company. It owns 100% of a real estate company, which means the entire value of this company is derived from real estate. It transfers or sells the shares of this company to an Indian resident and makes capital gain. These clearly are taxable in India because there's a direct derivation of the value of the company from immovable property. Second example could be a foreign company owns 100% in a holding company, right? And this holding company owns a real estate company of rupees 100 and other assets of 50. Now, if you see, when there is a transfer of shares of the holdco to an Indian resident, the value of the holdco, if you see, is 100 plus 50, 150. Out of this 150, the real estate company is valued at 100, which is approximately 66.67%. So the value of the holdco to the extent of 66.67% is derived from immovable property company, right? In that case, the 50% criteria is met, and therefore these capital gains will be taxable in India, in addition to the fact that they will be taxable in Mauritius. Let's look at another example. The same foreign company owns a holding company in India. This holding company owns a real estate company whose value is 40 rupees. It has other assets worth 60. The shares of this holding company are transferred to an Indian resident. Since the value of these shares is derived from the real estate company to the extent of only 40%, this will not be covered under Article 14.4 of the India-Malaysia Treaty or relevant corresponding Article 13.4 in other treaties. It is not taxable in India.